Welcome to the deep dive. We're shaking things up a bit today.
Oh, yeah.
Yeah, moving beyond the usual stocks and bonds talk to explore, well, the pretty interesting world of alternative investments.
Alternatives. Okay.
Specifically, we're focusing on derivatives
Mhm.
and cryptocurrency-related investment products.
Two big ones. Lots of buzz around those.
Exactly. Think of this as like your quick guide to understanding what they are, how they actually work, the good, the bad, maybe the ugly, and where they might fit or maybe not fit in your overall investment strategy.
It's definitely an important area to get into, especially right now. The big shift we're seeing is access.
Access. How so?
Well, it used to be, mainly big institutions, hedge funds, really high net worth individuals who could play in this space.
Right, not for the everyday investor.
But that's changing now through things like mutual funds, ETFs.
Right.
Well, individual investors like you can increasingly get involved.
Okay, that's a key point.
Hmm.
And we know you're busy. You want to get smart on this stuff without needing a finance degree.
Right. Keep it clear.
So let's dive right in. Why even look past stocks and bonds? Aren't they the bedrock?
They often are, yeah. A solid foundation. But relying only on them, it can limit your diversification, limit how you manage overall risk. The whole idea behind alternatives is they often don't move perfectly in sync with those traditional markets.
So they might zig when stocks zag, that kind of thing.
Potentially, yes. It could help smooth out some of those bumps in your portfolio's value over time.
So adding different flavors to the mix maybe makes it less volatile overall?
That's the goal, precisely. Historically getting into things like, say, hedge funds or private real estate, even collectibles, that was tough for most people.
Very exclusive, yeah.
But like we said, the landscape's different now. More accessible options are popping up, often in those familiar fund formats. ETFs, mutual funds.
Okay, so that covers the why. Let's tackle the first big topic then, derivatives. Bit of a scary word for some. What are we actually talking about here?
Okay, derivatives. Think of them fundamentally as financial contracts. Their value isn't inherent to the contract itself. It's derived from something else, an underlying asset.
Derived, okay, like what kind of asset?
Oh, almost anything. Commodities, oil, corn, wheat. Stocks, bonds, interest rates, currencies. Even other derivatives, believe it or not.
Okay. Derivatives on derivatives.
Yeah.
So it's almost like a bet on where the price of something else is going, but you don't actually own the thing. Is that fair?
That's a decent way to think about the speculative side, yeah. But they really serve three main purposes. First, hedging.
Hedging, like protecting yourself.
Exactly. It's basically like buying insurance against unwanted price moves. Farmers do this, airlines.
Right. Like that classic example. The wheat farmer locks in a price with the miller using a futures contract.
Perfect example. They both protect themselves from price swings. It gives them certainty.
Financial peace of mind. Okay, so hedging is one. What else?
Second is speculation. That's where you are aiming to profit from price movements, maybe amplify your exposure.
Okay, the betting part.
And third, they can sometimes give you access to markets or assets that are just hard to trade directly.
Interesting. So hedging, speculating, accessing, got it. Now, I hear there are different types.
Broadly, yeah. You can think of them in two main camps. Lock products and option products.
Lock and option? Okay.
Lock products, think forwards, futures, swaps these, create an obligation for both sides. You're locked in to fulfill the contract terms. It's a firm commitment.
Locked in.
Okay.
And options. They give you an option.
Exactly. Simple options. Warrants these give the buyer the right, but crucially, not the obligation, to buy or sell that underlying asset at a set price, the strike price, by a certain date.
So you pay for the choice, but you don't have to go through with it.
Precisely. You pay a price, called the premium, for that flexibility.
So with a lock, everyone's committed. With an option, the buyer pays for the right to choose later. How does their value change?
It's different. Lock products, when they start, theoretically have zero value. Their value then moves based on the underlying asset's price. Becomes an asset for one party, a liability for the other.
Okay.
Option products, though, they have value right away. That premium you pay. It reflects two things.
Two things.
Yeah. First, any immediate potential profit if the current price is already favorable compared to the strike price. That's called intrinsic value.
Okay, intrinsic value.
And second, the value based on the time left until the option expires. That's time value. It decays as you get closer to the expiration date.
Right, because there's less time for the price to move in your favor. So the initial cost reflects that potential and the time window. Now, speculation, You mentioned it. Derivatives can be used for that, sometimes with, well, pretty dramatic consequences. Nick Leeson, Barings Bank. That story comes to mind.
Absolutely. A classic cautionary tale. Leeson's unauthorized trading, mainly in futures, racked up huge losses that bankrupted Barings. It really highlights the leverage involved. Derivatives can magnify gains, but they equally magnify losses. Risk management is absolutely critical.
So huge potential upside, but equally huge potential downside. And it's not just rogue traders, right? We see derivatives used in some ETFs too, like inverse or leveraged ones.
Yes, exactly. Those specialized ETFs use derivatives, often swaps or futures, to try and achieve returns that are, say, the opposite of an index, or maybe double or triple the index's move, usually on a daily basis.
Daily basis.
Yeah, they typically rebalance daily, which adds complexity. They can be useful tools for sophisticated traders for short-term moves, perhaps, but they carry extra risks and aren't really meant for long-term buy-and-hold investing.
Right. Definitely need to understand how those work.
Okay.
Maybe we can quickly run through some common derivative types. We mentioned forwards and futures.
Sure. Forwards are generally customized contracts traded privately between two parties over the counter, or OTC.
Tailor-made.
Right. Futures are standardized contracts traded on exchanges with a clearinghouse acting as an intermediary. That standardization makes them easier to trade.
Okay. More standardized, exchange-traded,
Yeah.
then options the right, not obligation.
Correct. Call options give the right to buy, put options give the right to sell.
Got it. Binary options. Heard of those?
Yeah, those are a bit different. It's more of an all-or-nothing payout based on whether an event happens or a price level is reached. Very speculative.
Okay. Warrants.
Warrants are kind of like long-term options, often issued by companies themselves, sometimes traded OTC.
Longer time frame. And swaps. What's being swapped?
Cash flows. Swaps are agreements to exchange future cash flows based on some underlying rate or price. Interest rate swaps are very common, maybe swapping fixed-rate interest payments for floating-rate ones.
Ah, okay.
Or currency swaps, exchanging principal and interest in one currency for another. Businesses use these a lot to manage exposure to interest rate or currency fluctuations.
Okay, managing financial exposures. Now, things get maybe even more complex. Collateralized debt obligations, CDOs, credit default swaps, CDSs. These names pop up a lot when talking about the 2008 crisis.
They certainly do. They were right at the center of it. CDOs. Okay, picture a pool of debt. Could be mortgages, corporate bonds, whatever.
Right.
That pool is sliced up into different pieces called tranches. Each tranche gets paid in a certain order and carries a different level of risk and potential return. The lowest, riskiest tranches absorb losses first.
So the top tranches were seen as safer.
Theoretically, yes, that was the idea. Now, credit default swaps, CDSs, think of them like insurance policies on those debts or on bonds.
Insurance against default.
Exactly. The seller of the CDS agrees to pay the buyer if a specific loan or bond defaults. In return, the buyer makes regular payments, like an insurance premium.
Okay, that sounds reasonable enough. What was the problem?
Well, one issue was naked CDSs. That's where you could buy protection, buy a CDS on a bond or CDO tranche that you didn't actually own.
You could bet on something failing without actually holding it.
Yes, and a lot of these were traded privately, OTC, so it was hard to know who owed what to whom. When defaults started rising, especially in subprime mortgages packed into CDOs, the whole system became incredibly fragile. Lack of transparency was a huge issue.
Wow, okay. And mortgage-backed securities, MBSs, related.
Very related. MBSs are specifically pools of mortgages, again, often sliced into tranches with different risk levels. They allow mortgage risk to be spread among investors.
But when those mortgages are subprime and start defaulting en masse.
The losses cascade through those tranches, and if they're inside CDOs, which then have CDSs written on them, you see how interconnected and complex it got. It amplified the whole crisis.
Definitely sounds complex. So despite all these risks we've been talking about, derivatives must serve some useful economic functions, right? Otherwise, why would the market be so huge?
Oh, absolutely. They play several important roles. One is price discovery.
Price discovery.
Yeah, the prices of derivatives, like futures, reflect the market's collective expectation about future prices of the underlying asset. It helps reveal information.
Okay, like a forecast.
Kind of. They also allow for risk reallocation. A business that faces a certain risk, like changing fuel prices, can use derivatives to transfer that risk to someone else who's willing to bear it, maybe a speculator.
Shifting risk around. Makes sense.
They can also increase trading volume and liquidity in the underlying spot markets. And some argue they allow for more controlled speculation compared to trying to speculate directly in some physical commodities, for instance.
And the scale is just massive, isn't it?
Absolutely enormous. We're talking trillions upon trillions of dollars in notional value outstanding, both in the regulated exchange-traded markets and the larger, less transparent over-the-counter market. It's central to global finance.
But that scale, again, points to the potential for huge losses.
Yeah.
We mentioned Barings, but there are other examples, right?
Yeah.
AIG during the crisis, Société Générale.
Definitely. AIG needed a massive government bailout, largely because of losses on CDSs it had sold. Société Générale had a huge trading loss attributed to unauthorized derivative trades. Other names come up too. Amaranth Advisors, long-term capital management back in the 90s, Metallgesellschaft. These instruments, especially with leverage, can lead to catastrophic losses if not managed properly.
And that risk that the other party in the deal just can't pay up. Counterparty risk, that seems like a big one, especially for those private OTC deals.
It's a fundamental risk, yes. If you have a contract with someone and they go bankrupt, your contract might be worthless. That's a major reason why reforms after the crisis, like the Dodd-Frank Act in the U.S., pushed for more derivatives to be centrally cleared.
Centrally cleared.
Yeah, using a clearinghouse as an intermediary between the two parties. The clearinghouse guarantees the trade, reducing that direct counterparty risk between the original traders. The reforms also mandated more reporting to increase transparency.
Trying to make the system safer, more transparent. Okay, that's a lot on derivatives. Let's pivot now to that other area of alternatives, cryptocurrency-related products, getting a ton of attention. Bitcoin ETFs are probably the most visible example lately.
They really are. Bitcoin ETFs offer a way for investors to get exposure to Bitcoin's price movements, but indirectly, through their regular brokerage account.
So no need to set up a crypto wallet, worry about private keys, all that stuff.
Exactly. That's a big part of the appeal, especially for people maybe curious about crypto, but intimidated by the direct ownership process. It offers convenience.
Buy and sell it like a stock or any other ETF.
Pretty much. And there might be potential tax advantages too, particularly if you hold these ETFs within certain tax-advantaged retirement accounts, like some types of IRAs. Holding crypto directly can have different, sometimes more complex, tax implications.
Interesting point, though tax rules can change, of course.
Always important to stay updated or consult a professional on that, yes.
And besides the ETFs, platforms like E-Trade mention other ways to get indirect crypto exposure, like trusts or futures, though they seem to emphasize the risks there.
They do, and rightly so. You might see things like cryptocurrency coin trusts. These often trade over the counter, and they can sometimes trade at a significant premium or discount to the actual crypto price, plus they have fees.
Okay, so the price might not track perfectly.
And then there are cryptocurrency futures. These are definitely high risk. They involve leverage, meaning small price movements can result in large gains or large losses. Really not suitable for everyone. You need a high risk tolerance and a deep understanding.
High risk, high leverage.
Got it.
And I suppose you could also just buy stock in companies involved in crypto.
Yeah.
Like miners or exchanges.
That's another route, yeah. Investing in companies that are part of the crypto ecosystem gives you thematic exposure, but it's still indirect and tied to the company's performance, not just the crypto price itself.
Right. But the common thread here seems to be risk. High risk.
Absolutely crucial to emphasize that. Transacting in any cryptocurrency-related product is inherently risky. The market is famous for its extreme volatility.
Yeah, big swings.
Big swings. And unlike traditional stocks backed by company earnings or bonds backed by debt obligations, many cryptocurrencies lack those fundamental anchors. Their value is often driven by sentiment, adoption trends, speculation. It means there's a very real possibility of losing your entire investment.
Total loss is possible. So the message is, really do your homework, understand what you're getting into, understand the cryptocurrencies themselves, and the specific risks of the product you're considering.
Couldn't say it better. And it's worth remembering, too, that while firms like Fidelity or E-Trade might provide access to these products on their platform...
Yeah, recommending them.
Exactly. They generally state clearly that they don't provide recommendations or endorsements for digital assets. Access isn't the same as advice or approval.
Very important distinction. Okay, so we've talked about potentially higher returns with alternatives, maybe diversification benefits, but clearly significant risks, complexity, volatility. How do you suggest listeners think about balancing the potential rewards with these undeniable risks?
That really is the million-dollar question, isn't it? It's a balancing act. Yes, some alternatives do offer the potential for returns that might beat traditional markets.
That's the lure.
That's the lure. But that potential almost always comes with higher risks. We've mentioned volatility and complexity. Another big one can be less regulation, especially for structures outside of regulated mutual funds or ETFs. And a really key one, liquidity, or rather, a lack thereof.
Liquidity, meaning how easily you can sell it and get your cash back quickly without taking a big hit on the price.
Exactly that. Many alternative investments, especially things like private equity, private real estate, some hedge funds, they can be very illiquid.
Hard to sell.
Can be very hard to sell quickly. You might be locked in for years. And trying to get your money out early, if even possible, could come with hefty penalties.
So, not great if you might need the money unexpectedly.
Definitely not. That's why these less liquid alternatives tend to be more suitable for investors with a long time horizon who are confident they won't need that capital for, say, 5, 7, 10 years or more.
Okay. But going back to what you said earlier, accessing alternatives through those more common vehicles like mutual funds and ETFs, that can help with the liquidity issue, right?
That's a huge advantage of these newer, more accessible options. Liquid alternative mutual funds or ETFs, you can typically buy and sell them daily, just like traditional funds. And their fees might be more in line with traditional funds too, though you still need to check.
So more flexibility there.
Yes. So summing it up, diversification using alternatives can be a valuable tool. It can potentially enhance returns, maybe even add some stability over the long run. And it's a big, but diversification doesn't eliminate risk. Nothing does.
You can't just set it and forget it, especially
Yeah.
with these.
No. And, established players like Fidelity are now offering various liquid alternative strategies wrapped up in those familiar fund structures, trying to offer some of those benefits with better liquidity.
Okay. One last thing, maybe. The difference between investing and speculating. That line seems like it could get pretty blurry with assets like derivatives or crypto, which can be so volatile.
It can be blurry, yeah, and people define it differently. But generally speaking, investing usually implies a longer time horizon.
Thinking long term.
Right. Maybe focusing on generating income or long-term growth based on some underlying value or fundamentals. Risk is managed, considered carefully.
Okay. And speculation.
Speculation often involves shorter time frames. The main goal is often to profit from price fluctuations themselves, rather than underlying income or value generation. And usually there's a higher tolerance for, or acceptance of, risk, betting on price moves.
Betting on price moves. And I guess how risky you perceive it also depends on how much money you're putting in relative to everything else you have.
Absolutely. What might be a small, acceptable speculative flyer for one person could be a dangerously large chunk of capital for someone else. Your own financial situation, your goals, your comfort with potential losses. Those are paramount.
Understanding yourself as an investor. Crucial. Okay, so let's try and wrap this up. Bringing it all together, it seems clear that alternative investments covering this wide range from complex derivatives to crypto-related products, they do offer potential pluses. Diversification, maybe higher returns.
Potential, yes.
And it's a significant, but they come packaged with substantial risks. Complexity, volatility, liquidity issues, regulatory differences, things that really demand you do your homework and understand them deeply before you even think about jumping in.
That is the absolute key takeaway. You really, really need to pause and think hard about your own investment goals, your personal tolerance for risk, how much sleep you'd lose if things went south, and your time horizon. How long can you leave this money untouched?
Right. Consider those before looking at these alternatives.
Definitely. And with these options becoming easier to access, maybe through that EPF or a mutual fund on your brokerage platform, well, that convenience makes it even more important to educate yourself. Don't mistake easy access for low risk or simplicity.
Good point. Easy to buy doesn't mean easy to understand or risk-free.
Precisely. So, maybe a final thought to leave you with. As these lines between traditional investing and alternative investing keep blurring, with new products emerging all the time.
Yeah.
It really makes you wonder, doesn't it? What new strategies, what new ways of thinking about risk management will you need to navigate the future of your own portfolio? Something to mull over.